Welcome to the channel. Today we are tackling a topic that's absolutely essential for anyone looking to generate income from the stock market. Dividend investing. It gets pitched as this almost foolproof set it and forget it strategy. You just buy a few stocks that send you checks and watch the money roll in, right? Well, the reality is a little more complicated than that. I've spent years figuring out what separates the successful dividend investors from those who just end up spinning their wheels. And trust me, I've made a couple of these mistakes myself back in the day. The whole point of this video is to save you the time, the money, and the headaches that come from learning these things the hard way. We're going to break down these blunders one by one, explaining what the problem is and giving you a practical fix for each. Let's get started. The first and by far the most common trap is chasing those crazy high yields. It's so tempting. You log into your brokerage account, sort stocks by dividend yield, and see a company paying out 8%, 10%, maybe even 15%. Your first thought is, wow, a 15% return in cash? Sign me up. But this is often what's known as a dividend trap. Here's the catch. An unusually high dividend yield is often a giant red flag. A stock's yield is just its annual dividend divided by its stock price. So if the stock price has been tanking, the yield shoots up into the stratosphere. That plummeting stock price is the market screaming that the company is in trouble. That spectacular yield isn't a sign of a healthy business, it's a sign of a distressed one. The company is probably facing major problems, and that juicy dividend you were excited about is very likely to get cut or disappear entirely as they scramble to save cash. The fix is to stop looking at yield by itself and start focusing on dividend sustainability. Instead of asking how high is the yield, you need to ask, can this company actually afford to pay this? A great place to start is the payout ratio. This tells you what percentage of a company's profits is being handed out as dividends. If the payout ratio is over 100%, the company is literally paying out more money than it's making. That's a recipe for disaster. A healthy payout ratio is usually under 70%, which shows the company has cash left over to reinvest in its own growth and handle any rough patches. You want to find companies with strong financials, low debt, and steady cash flow. That's the real sign of a dividend you can rely on. This leads us right into the second big mistake, which is a little more subtle. Focusing only on the current yield while completely ignoring dividend growth. An investor might see a stock with a 4% yield and another with a 2% yield and just instinctively grab the 4% yielder. But they could be leaving a massive amount of money on the table in the long run. The problem with a high yield that never changes is that inflation eats its lunch over time. A $1,000 dividend payment today won't buy you nearly as much stuff in 10 or 20 years. Dividend growth is a secret weapon against this. Companies that have a long history of increasing their dividends every single year, you might have heard them called dividend aristocrats or kings, are showing off their incredible financial strength. That consistent growth is a powerful signal that management is confident about the company's future. The solution is to change your mindset from income now to income growth over time. Hunt for companies with a proven track record of raising their dividends year after year. Yes, the starting yield might be lower, but the power of compounding that growth is incredible. A 2% yield that grows by 10% a year will eventually pay you way more income than a 4% yield that stays flat. This idea is called yield on cost, and it's how real long-term wealth is built. You want to own businesses that aren't just paying you today, but have the power to pay you more and more every single year. Mistake number 3 is getting so hypnotized by the dividend checks that you forget all about total return. Total return is the whole picture. It's your dividend income plus any increase in the stock's price. Too many investors think that as long as those dividends are hitting their account, it doesn't really matter what the stock itself is doing. That is a dangerous way to think. The issue is simple. A 5% dividend doesn't mean much if your initial investment shrinks by 15%. If that happens, you didn't make money. You've actually lost 10% of your capital. You got lured in by the income, but your overall wealth went down. Relying only on dividends is like trying to fly a plane using just one of its two engines. The solution is to always look at a dividend stock through the lens of total return. Before you even think about buying, ask yourself, is this a quality business that I truly believe will be more valuable 5 or 10 years from now? Don't overpay for a stock just because it dangles a nice dividend in front of you. Check its valuation with metrics like the price to earnings ratio. A fantastic company bought at a terrible price can still be a terrible investment. Your goal is to find companies that provide a steady, growing income stream and have the potential for the stock price to go up over the long haul. That's the real winning formula. The final mistake is putting all of your dividend eggs in one basket. It's easy to do. An investor falls in love with a sector that's famous for high dividends like utilities or real estate and just loads up the portfolio. They think they're building a fortress of income. The problem is, when you're over-concentrated in one area, you're taking on a massive amount of risk. Every industry has its ups and downs. If new regulations hammer the utility sector or a jump in interest rates hurts real estate, your entire income stream could be in danger all at once. That's the exact opposite of the safety that dividend investors are looking for. Real security comes from having income from a bunch of different unrelated places. The fix is simple but absolutely critical. Diversify. Make sure your dividend portfolio is spread out across different parts of the economy. Own some tech, some healthcare, some industrial stocks, and some financials right alongside those classic dividend payers. That way, if one sector is having a bad year, another might be doing great, which keeps your overall income stable. A good rule of thumb is to not let any single stock become more than 5% of your portfolio. And make sure your dividends are flowing in from a wide variety of industries. So let's quickly recap the biggest mistakes we've covered. Number 1, chasing those huge unsustainable yields. 2, ignoring the incredible power of dividend growth. 3, focusing only on the dividend check and forgetting about total return. 4, not using tax advantaged accounts and giving too much to the tax man. And 5, not diversifying, which puts your income at risk. Avoiding these traps is what turns dividend investing from a source of stress into a powerful and reliable engine for building wealth. It really just takes a shift in your thinking, away from a short-term hunt for yield and toward a long-term focus on quality, growth, and building something that will last. If you found this breakdown helpful and want to learn more about investing smarter, do me a favor and hit that subscribe button and turn on notifications so you don't miss what's next. And I've got a question for you. What's the biggest dividend investing mistake you've ever made, or one you see people make all the time? Drop it in the comments below. I read every single one. And sharing our experiences is one of the best ways we can all get better as investors. Thanks for watching, and I'll see you in the next video.